Okay, we want to first thank our viewers for participating in the CNBC TV18 budget quiz. The question was, this finance minister asked SEBI in the budget speech to raise the minimum public shareholding in companies to 35% from 25%. And the correct answer was C, Nirmala Sitharaman in the budget 2020. And here is today's winner. Congratulations, Trideep Bhattacharya. Remember, keep watching CNBC TV18 win prizes daily on the CNBC TV18 budget quiz. Okay, for the markets, there has been a recovery in the last few minutes. The low today was 17,493. For simplicity, 17,500. So from that level, there has been a recovery of close to about 70 to 75 odd points. So that is a bit heartening. The mid-cap index too is now down 500 points. It was down far more some time back. Let's invite Trideep Bhattacharya, the Chief Investment Officer, Equities at Edelweiss AMC on the show now. Trideep, I remember our last conversation where you said that in this earnings season, the earnings upgrade cycle is going to be tested. What have you made of the earnings so far? What was your thesis? Has it played out as per your expectations?
First of all, thanks for having me on your show. I think one of the things that we have been talking about since the beginning of this year in terms of one of the themes for 2023 would be, recession before rebound. In the sense, globally, we are likely to face recessionary conditions before rebound. And one of the drivers of that has been the quick succession interest rate increase of close to about 500 basis points that we have seen globally and will now flow through the economies, to various economies in different degrees in the first half of calendar year 2023. What I said to you earlier was in a continuation to that in the context of a rate headwind flowing through the economy, the earnings upgrade cycle is likely to be tested. And I think if you look at the earnings that have come so far, I would say that the pockets of growth or the pockets of beats have been certainly narrower and more pointed. And generally, the commentary has been probably kind of, cautiously optimistic, throwing a bit of caution more than optimism so far. While some sectors have reported good earnings, some have reported some meaningful misses, like probably one we saw today or the last couple of days.
Hi, Trideep. Nigel on this side. Trideep, private sector banks is something that you liked. Now you're getting some of these stocks, at a sharp discount to what you would have got it a couple of weeks or so ago. And ICICI Bank has broken its 200 EMA today. Your view on the banking names, and from the stocks that you have, what's the pick of the pack?
So my sense is that, two bits. The first bit I talked about that the first half is going to be fairly volatile. So, and hence we have to take some of these movements that you're seeing in share prices. That will happen quite a few in the first half of 2023, and investors should be prepared for that. But that being said, from a 2 to 3 year perspective, I will continue to be positive on some of the private sector banks. And over a period of the next 6 months, we would look to use these declines as a way to sort of enhance our position wherever there is a scope, particularly in some of the banks where the earnings momentum is robust. And the reason why we like this is because after 2 to 3 years of bad asset cycle, we are now turning around. The corporates are more deleveraged, and credit growth is gradually picking up over a period of last 12 to 18 months, and that is probably likely to continue, over the medium term.
Got that, Trideep. Good talking to you today on the show. Let me ask you how you're playing the consumer. I mean, we all know that, and especially on the discretionary side, whether we are talking to hotel companies or, even some of the numbers like, stocks like Shoppers Stop, etc. The consumer is alive and kicking. We know that. We know that in retail loan growth as well, for that matter. So how would you play this part of the market?
So we have been and continue to be underweight the consumer as a basket. And when I say as a basket, I mean including consumer staples, consumer discretionary, and further up the discretionary chain, which would include hotels, this, that, the other. We have been underweight this space for a good 6-9 months. I think historically, the change in color within the consumer sector has been historically the pocket of growth within consumer has been the urban demand. In my opinion, over the next 6 months, you will see that growth also taper down to a certain extent, while rural demand might see some semblance of growth. not exactly a huge rebound, but some semblance of growth. And partly that is driven by the whole impact of rate increases that we talked about and the commodity price increases which have been passed through by the companies to the consumer. All of that impact will flow through in the first half of calendar year 23. So as a starting point, we are reasonably cautious within consumer. Within consumer, we are probably incrementally tilted more towards staples than discretionary than what we have been in the past. That's our thinking at the moment.
Okay, so you're underweight consumer staples as well as discretionary and the entire gamut of hotels, airlines, because you believe the urban demand, which was strong up until now, will start wilting with the rising interest rates. Where do you stand on IT? Here we're getting some mixed opinion. Many believe that it's still going to be, weak for the sector in 2023. Some believe we're closer to the bottom or at the end of this downward cycle that we've been. Where do you stand on IT, and what would be the big triggers for IT from here on?
In my opinion, the worst point of uncertainty has been roundabout is something that we are going through right now. And if I divide the sector from a outlook standpoint into two parts, P multiples and earnings overall, I would say that the sector over the back half of last year went through a good round of PE derating. So the PE derating part is reasonably complete. Earnings calibration versus how the demand might turn out to be in calendar year 23, the current calendar year, or FY24 for most of the corporates is currently underway. And I think over the next 2 to 3 months, you will see a reasonable amount of clarity in this area as well. So with PE derating done, earnings being recalibrated, we have reduced our underweight in IT over the last 3 to 4 months. We are still selective. It's not that it's one of the most overweight sectors that we have, but incrementally we have reduced our underweight and we have probably increased our weightage over the last 2 to 3 months in this area.
Okay, got that, Trideep. Thank you for joining us and giving us perspective on the markets today. Great talking to you. As always, the market actually is trying to fight back. To some extent, for what it's worth, about a 100-point recovery from the lows of the day. Just a quick take on some of the stocks that are trying to fight back. Actually, it's Infosys. The likes of Dr. Reddy's anyway have been positive. L&T is trying to, really pull up from the lowest point of the day. So there's some sort of pullback as is quite evident. Perhaps some semblance of short covering also coming through. A little easing of the pressure. We'll take a break on that note. And as always, we'll get you the calls for tomorrow, rather Monday this time around, with the technical experts in just a bit.